90% of traders lose their money. And I'm not going to give you the same reason you've heard online because of trading mindset and trading psychology. Those are not the reasons. That's just garbage you've been fed. The real reason why 90% of people lose their money is because they have no idea how to size their positions and how to manage risk. And what percent of their portfolio should they actually dedicate to one trade. Most of the people trade like they have no idea. As someone who's been mentored by Wall Street pros, I know exactly how you should size your positions, when to size up, when to size down, and in this video, I'm going to break it down. Alright, so how do people lose money? Let me give you an example. So let's say Pedro goes all in on an Nvidia earnings play. He has about $5,000 as his entire portfolio. So he buys out of the money calls on an Nvidia earnings worth $5,000. What do you think happens? He loses it all. Even if Nvidia goes up, he'd still probably get IV crushed and lose all his money anyways. What you should do is just risk a part of your portfolio. And if you've actually picked up a book on finance, say The Alchemy of Finance or The Mind of a Great Trader by The Alchemy of Finance by George Soros, or any other such book, Ray Dalio's book, you will realize that their win-loss ratio is more like 50-50. Don't take my word for it. Look at the books. It's 50-50. They've all said it. Now, with a 50-50 win-loss, you know that you can have a succession of losers and a succession of winners and losers just like in a row. It's arbitrary. It can happen. You have no idea. So if you size up your position size, if your position size is actually like a huge chunk of your portfolio and you have a succession of losers, you're going to get blown out. That is horrible risk management, and that is exactly how you should not trade. What you should do is, let's assume like $100,000 portfolio. You don't touch $50,000 off that. You size your positions at risking maybe like 5% of your portfolio. So on every trade, we are risking $5,000. Now, if we are risking $5,000 a trade and our risk reward in every trade we take is 1.5 to 1, well, to construct trades using such a high risk reward, in my course linked in the description below, I completely break down how you can structure options, high probability plays, where you get at least a minimum 1.5 to 1 risk reward on every play. So we risk 5% per position and our risk reward is 1.5 to 1. Now let's say you take 10 trades a month. So in 1 year you take 120 trades. Assuming a 50-50 win-loss ratio but a 1.5 to 1 risk reward, your return at the end of the year is 400%. I use Python and this is the graph on Matplotlib I created modeling those returns. Totally insane. All you have to do is not be Pedro.